Good morning, students. Namaskar, Vanakkam, Sat Sri Akal, Shubh Prabhat, Kem Cho, etc., etc., etc. So I am C. Ankit Sharma again, and we are going to discuss today again the PGBP provisions. Before the class, of course, I have already received a lot of good morning from Sudhanshu, Sushil, Manisha, Komal, Bhumika, Darshan, Rajiv Kumar, Madhav, Amrit, Vishwantha Reddy. So again, a very good morning to all of you and to all of those students who are still sleeping. So please wake up, please join the class, please try to join the live class always. It is really going to help you in your studies. So result is announced on, I guess, 5th of July. And as I told you that my 8 articles was actually waiting for the result, and a good news and a bad news. 4 of them have cleared, of course, their groups, and 1 of them become a chartered accountant. So congratulations to all of those who have cleared your examination and who will still try. In CA, technically, nobody fails. So never say if you are not able to clear your group, do not say that you failed in CA, of course. And it just you did not clear that attempt. That's it. You're just not able to clear this attempt this time. That's it. You are not going to be a failure in CA unless you will quit. You will be a failure if you leave CA. If you quit this course, only in that case you will be as a failure. But until you are in this journey, in the process, if you are fighting, if you are giving the next attempt, if you are studying again, that means you are still in the game. So you are never treat yourself as a failure in this course until you are going to leave this course. And please, please do not leave this course. If you won't leave CA, CA would not going to leave you. So later or sooner you will be a CA, and a CA is always a CA. So try to pass as soon as possible. But if you are not able to clear this time, do not demoralize. Do not demotivate. Just believe one thing, nobody is fail in chartered accountant course. It just you are not able to clear this attempt. So practically what happens when we did not able to clear it, we are not going to clear the group. So everybody say you failed in CA. That's why there is a problem in our mind. We are going to feel that we are a failure. I am a failure, but that's not the case. We're just not able to clear this group this time. That's it. Do not take burden. Believe me, what I'm saying is true. Once you will clear, you will forget every pain you had. But do not quit this course. Do not leave this course. So please be in the game. Again, work hard. Find your weakness. And one more thing, do not go for selected study ever, ever, ever. You have to study each and everything. So institute is very, very intelligent. They know that some students or some of them is going to have a selected part, the important chapters only. But now the question paper has been set like this, that they are going to ask everything from every chapter. So please go for comprehensive studies. Do not go for selected study and work hard. If you are not able to clear this attempt, do not bother. Find your weakness. That's the most important thing. So if there is some chapter you are not able to understand, do not leave them. You have to study them. Without studying everything, you're not able to clear this course. So please be there. Do not be motivated. Once you will be a CA, you will always be a CA. You will forget all your pain, etc. So it's a journey. You have to keep fighting. And one day you will win. I promise one day every one of you will win. Okay? So before starting the class, let me share you a very, very beautiful quotation from a very, very renowned person. So we all know him. He is Swami Vivekananda, and he exactly say the same thing. That is, arise, awake, stop not. So arise do not mean that you need to get up in the morning. Arise means you need to self-arise yourself for your goal, for your target, for your aim. You should arise. You should understand that, yes, this is my future. My future is depend upon this thing. So you need to arise your inner feeling to achieve your goal. Awake. You have to awake also. You should understand that yes, this is my life. I need to do this thing. This is something which can make my dream comes true. So you need to arise, awake, stop not, and do not stop until you are going to achieve your goal. So if you are not able to clear this time, do not stop. Do not believe on anyone. If somebody is saying you can't do this, you have not that capability to complete this course, do not listen. Do not listen. You should leave these kind of people. You should not interact with them who are going to give you negative thoughts. And I am the real example in front of you. I was not a brilliant student. I have no hesitation to accept this. I was a very, very average student in my school time. And once I told you, once I realized myself that yes, I need to do this course. I need to make my future. At the time, I arise, awake, and stop now. I completed this course almost in 3 years. I joined this course after graduation. So I completed this course after my graduation. I did not go from foundation way. I just going from intermediate and final. So till graduation, I was not clear about my goal. But once I realized that I need to do chartered accountant course, I didn't stop. So please, you all should understand this thing. Arise, awake, stop not until the goal is reached. So that was the beautiful quotation from my side to all of you who are listening to me or those who are watching. Please do not quit. If anybody or any of your friends is thinking about quitting this course, please motivate him that he or she should not quit this course. It's a beautiful, wonderful course which will make your future. It takes time. Good things takes time. So it is taking time. You should find your weaknesses. That is very important to achieve any goal in your life. You cannot win any fight with your weaknesses. Please overcome that. And I believe all will be chartered accountant very soon. Okay. So we discussed provisions in our last class regarding scientific research, section 40, discuss about the TDS provisions. On some expenses, there should be deduction of TDS up to due date of ROI, in some case up to due date of TDS, etc., etc. There were cases regarding non-resident, payment to non-resident, payment to resident in India, and payment to resident outside India. We also discussed the partnership firm provision. We are going to discuss today illustration regarding that, of course, and we will further move on to our other provision. I personally believe that today we will be able to complete all the important provision, numerical provision regarding PGBP, and there might be some theoretical provision will left. So I just wanted that we should cover almost all the provision today. So in the next class, which is on 10th of July regarding PGBP, our last session, I will take all the practical problems in your study, which is for test your knowledge topic. So I just wanted to take all the problems. I'm going to discuss all the problems with you and as well as the chart presentation of almost all the numerical section. I will upload chart presentation on tomorrow or maybe day after tomorrow, but before our 10th of July class. So in the class, I am going to discuss with the chart discussion and all the numerical topics, all the numerical provision, all the numerical question with you. And I'll try to revise the provisions once also with the class. So I want a lot of time in our 10th of July class. And I want one thing from all of you also. Please, after today class, revise once again the whole provision from day 1, day 2, day 3, and day 4 class. So today is our day 4 session of PGBP. So I request you all that before going for 10 July class, because in that class we are going to discuss numerical problems. So before that, you should revise once again the all provision we discussed. If you want to take any class, go on YouTube and again you can rewatch that. So it's a request from my side because I know if you'll revise the provision, then when we are going to discuss the problems, that will be really easy. Please trust me. Fine. I'm teaching from last 20 years. So please trust me. This is the most important thing that you should revise your provision before going for your practical problems. So again, good morning, Arshita, Kriti, Darshan. Okay, Darshan is asking a query. What is the treatment of bad debts recovered, sir? So if you write off any bad debts, if you written off any bad debt, that is going to be claimed in the debit side as a deduction. Okay. And if you are going to recover that bad debt, that is going to be treated as your income. So remember one thing, recovery of bad debt can only be allowed. Recovery of bad debt can only be allowed if the deduction of bad debt has been allowed earlier regarding that recovery. So if you have claimed a deduction of 1 lakh rupees bad debts in earlier year in your P&L debit as a written off 1 lakh rupees, and out of that 1 lakh you recovered 60,000 in previous year. So that 60,000 is going to be taxable in the P&L account credit side. So we are going to add that in our net profit. We are going to discuss these kind of numerical on 10th of July. Do not worry, but that is the provision of recovery of bad debt. I hope it's clear. So Darshan is asking that restriction on partners' remuneration to be calculated separately for each partner or as a whole. We are going to calculate the remuneration value for all partners together. We are not going to find the salary or remuneration to partners separately. We are going to find it all together. So if the salary has been distributed earlier as per accounting or as per partnership deed 50-50%, then the whole allowable amount will be distributed into the partners 50-50%. And if it is in another ratio like 60-40, 30-70, etc., then we are going to distribute the allowable portion of income tax salary or allowable salary of partners in that proportion. We are going to discuss these kind of question also, Darshan. Okay. Manisha is saying, sure, sir, we will definitely do. Just remember, if you are not going to leave CA, CA is not going to leave you. So I will upload all chart maybe today or tomorrow, definitely. So before 10th of July class, you should have all the diagrams on the portal. I have a query, sir. Miss Glory is asking, when will classes start for May 2024 exam, sir? Please send this query to your board of study or institute. They will, of course, going to give you the answer. Okay. So moving on to our MCQ test. First of all, before anything, I'm going to take the MCQ test. So I guess you all are ready for that MCQ test with a paper, pen, and calculator, and of course with your brain. So please read the question first. Then you should going to answer that question. Okay. So I guess you all are ready. Let me see who are ready. So please send me the that all of you are ready for that MCQ test. Today we are having third MCQ test. And that is going to show me that how much of you are actually preparing to becoming a chartered accountant. In Hindi, I always say to my student that दो तरह के स्टूडेंट होते हैं. In Hindi, in my class, I always told my students that दो तरह के स्टूडेंट होते हैं हमारे CA कोर्स में. एक जो CA करते हैं और एक जो CA बनते हैं. This difference doing CA and to be a CA. So please वो वाले students बनो जो CA बनते हैं. बहुत सारे ऐसे हैं, they just show that they are just doing this course, but they are not intention to become a chartered accountant because they are not ready for sacrifices. For sacrifices, their parties, for sacrifices, their fun moments, for sacrificing their traveling, etc. So they are just doing CA course. They are not going to becoming a chartered accountant. एक वो है जो CA करते हैं और एक वो है जो CA बनते हैं. आप कौन से वाले हो वो डिसाइड करो. बनना चाहते हो या सिर्फ करना चाहते हो. Okay. So I guess you all are ready. Sir, is there any special treatment of any amount payable to partners at the time of retirement? There is no such special treatment. At the time of retirement, they will get whatever the capital that is not going to be taxable, of course. If they are getting any remuneration, salary, or income thing, then that is going to be taxed. Okay. So Diksha is ready, Bhumika is ready, Kushi, Harshita, Prasad, Rajiv Kumar, Kavita, ready. Well done. You all are ready. So I am also ready. Let me share you the screen so you are able to solve this. This is question number 1 for all of you. An employer paid an amount of 10,000 as insurance premium on the health of his employees under a scheme framed by GIC, that is General Insurance Corporation. Okay. Such payment was made by check. The insurance amount was of 10 lakh. The amount of deduction available to employee. So insured value was 10 lakh. Insurance premium has been paid 10,000. And you need to tell me how much deduction that employer can claim. It's a very easy question. We have discussed that already. Okay, Darshan has given answer. That is, he's saying A. Diksha is saying A. Harshita is saying also A. So the correct answer is, of course, A. We have already discussed these provision in section 36, I guess, point number 1. Okay. Second. Okay, Malik and company engaged in trading activity could not recover 5 lakh from a customer. It claimed the entire amount as bad debt by writing off in the books of account. The aggregate sales made during the year to the party amounts to 30 lakh. The amount eligible for deduction by way of bad debt is. You need to tell me how much amount going to be treated as bad debt. Okay. Sudhanshu is saying B. Sudhanshu, always send your answer with the question number, because now I don't know you are giving the answer of question number A as B or question number 2 as B. Okay. So if this is the answer of question number 2, that's a wrong answer. Let's see. Amrit is saying again A. I don't know which question answer you all are given. So whenever you send your answers, kindly mention the question number. So I'll be able to tell that you are wrong or you are right. Okay. So question number 1 correct answer was A. Most of you have given the correct answer. Darshan is saying, sir, if the same is paid in cash, he is asking about question number 1. Yes, if the amount of premium is in cash, that cannot be allowed as deduction. Okay, question number 2 answer is coming. Somebody is saying C, and almost everybody is saying C, except I guess Vaishali. She is saying B. The correct answer is, of course, C. So I have told you something which is going to be write off as a bad debt. That is going to be allowed as deduction. So the correct answer is 5. So these are very simple. So there is nothing to discuss in detail in these questions. Question number 3. An assessee made a payment of 25,000 as a secret commission prohibited by law for some offensive purpose, which expenditure shall be considered as. You need to tell me, is it a revenue, capital, rapid revenue, or inadmissible expenditure? Question number 3. Almost everybody has given correct answer of question number 2. Well done, well done. All are arised and awake. Just need to do one thing. You should not stop until your goal is achieved. Okay. Question number 3rd answer. Students are saying D, and the correct answer is, of course, D, because that's kind of a violation. It's kind of a bribe which is not allowed. We have already discussed these provisions. Question number 4. Read it carefully and then only answer. Okay, it's regarding the TDS provision. Mr. Ramesh during the previous year 22-23 made royalty payment outside to non-resident on which TDS was not paid up to due date of TDS and section 200. However, such TDS was deducted and paid on 15th February 2023. When shall deduction of this expenditure be allowed to the assessor? I always suggest to the students, whenever you read the question, do not try to solve it directly. First of all, you should recall the provisions. So it's a question in which payment is made to a non-resident. So you should recall the provision for payment of non-resident regarding TDS. So there was two concepts. One was payment of salary to him or payment for other thing. So because we paid the royalty, that means the other, not the salary provision, the other concept will applicable. Now recall what is the provision regarding other than salary if we pay to the non-resident. And it was written there that if it is paid up to due date of ROI, it can be claimed as deduction. Now, what is the due date of ROI? That is July 23 or October 23 for this assessment year. And the TDS has been deducted and paid up to February 23. That means before the due date of ROI. So now if the payment in case of royalty to a non-resident and if TDS has been deducted and paid before due date or up to due date of ROI, then deduction is going to be claimed in which year? Now you should answer me. I've explained you the question. So now you should tell me in which previous year that expense is allowed as deduction. The royalty expense. We are not talking about TDS deduction. That is not going to be there. The payment on which TDS need to be deducted can be claimed as deduction in which year. So let's see. Somebody is saying B, Diksha is saying C, Manisha is saying B, and again somebody's mother is saying C. The correct answer is B. If TDS has been deducted in case of royalty, etc., if it's paid to a non-resident, then before due date of ROI or up to due date of ROI, that is allowed as deduction in the same previous year. That is the previous year 22-23 for which this expense relates. And if it is paid after due date of ROI, then in the year in which it has been paid. So question number 4. 5. Payment to resident in India. Just a second. Payment to resident in India on which tax has not been deducted or paid shall be disallowed to the extent of. It's a very simple question. You should know the answer. What is the correct answer of question number 5? A payment to a resident who is in India. And if TDS not been deducted or paid, what amount will be disallowed? What amount is going to be disallowed? Okay. So the correct answer is, of course, B. That is 30% because 70% is going to be allowed as deduction. Next question. XYZ Limited has made a payment of 10 lakh to Mr. C, a contractor on which tax was not deducted at source during the previous year. The amount of expenditure to be disallowed in section 40A will be. Always remember, if it has not been given that the payee is resident or whether non-resident or in India or outside India. So always assume if in question is not given that if we are paying something to someone, then the payee status and place is not given, then always treat him as a resident who is in India automatically. It is not given. So you need to give me the answer. The amount of expenditure to be disallowed in question number 6. Of course, that's a 30% disallowance, and that the correct answer is, of course, option number C. It's almost same kind of question like question number 5. 7. Which of the following taxes are allowed as deduction while computing the business income? Let's see. You are able to give me answer of this question. Question number 7. So let's see. Question number 7. No answer yet received by me. Fast, be quick. Okay. Somebody is saying C. Komal is saying C. Kavita is saying D. Varsha is saying nothing. Varsha is just written the question number 7. There is no answer. So the correct answer is, of course, C. GST. Because income tax, surcharge of income tax is not allowed. Because it is on the profit part. And anything which is on profit base cannot be allowed as deduction. So the GST is a part of indirect tax and that is allowed as deduction. The correct answer is, of course, C. E is the wrong answer. Okay. Next. Son of Mr. Raghu was appointed as a manager in his firm. Raghu made a payment of salary of 30 lakh to his son, whereas AO is assessing officer, is of the opinion that such expenditure is excessive or unreasonable having regard to the FMV, which comes to be of 24 lakh rupees. Calculate the amount of disallowance. Kitna amount disallowed hoga, you should need to tell me. So question number 8, we have already discussed the provision regarding this also, of course. But I guess we did not. Okay, section 40. If there is any expenditure which is exceeding the market value, then the X is going to be disallowed. I guess this provision we need to discuss today. You can skip question number 8. We will discuss it later. But for timing, it's a very simple provision. It says if you are making any payment to a specified person, that means your relative, etc. And if that expenditure exceeds the market value or the reasonable expenses value, then the difference is going to be disallowed. This is a provision we are going to discuss today. Okay, so you can skip it, but I have explained you the provision. It's very simple. Question number 10. You already answered question number 8. We have discussed this provision. Okay. The book profit of partnership firm is 1,20,000. The actual remuneration paid to working partner is 3,54,000. The allowable deduction section 40B towards remuneration to partner is. This is a question of partnership firm, and this is a good question, of course. These kind of question can come in examination for 1 or 2 marks. So it's a book profit is 1,20,000. So we have discussed the provision in our last class regarding this book profit and allowable salary. So the provision says allowable salary will be like this, up to 3 lakh of book profit, or in case of loss. The concept says 1,50,000. That is the fixed value, or 90% of book profit. Whichever is higher will be allowed as section 40B salary in this provision. So in our question, the book profit is only 1,20,000. So allowable salary will be 1,50,000 or 90% of this 1,20,000, which will come 1,08,000, and whichever is higher is 1,50,000. This is maximum salary allowable as per income tax. And again, allowable salary says income tax salary or as per accounting, whichever is lower. So that is 1,50,000. The correct answer is, of course, 1,50,000. That is option number A. Okay. Next, moving on to our last question. And I guess this is the most important question from all of us. I need to tell you that it's a very, very, very interesting question, and it's a quite tricky question also. It's again regarding the partnership firm provision. And in case of partnership firm, a partnership firm has net profit of 6,20,000 before deducting interest on capital to partners at the rate of 15%, that is 1,50,000, and working partner salary of 1,80,000 as the deed of the partnership. Now you need to calculate the total income of that partnership firm, which is going to chargeable as tax. So it's a very good question. Let me solve this for you. I have explained you the calculation of book profit provision in our last class. To calculate book profit, first of all, you take net profit as per income tax. We need to add back all the salary paid to partner as per accounting provision, full 100%. Okay. And we need to add back any interest to partner, which is in excess of 12%. Clear? After doing this, we will find out our book profit. So in this question, the net profit has been given 6,20,000 and it says clearly, remember this, before deducting, that means out of this 6,20,000, we did not deduct interest, deduction or salary to partners as per accounting. We add back salary to partner as per accounting provision if it has been deducted from this profit. We only add this salary to partner as per accounting if the net profit as per income tax has been given after deducting this accounting salary. But because in this question it says that this salary has not been deducted. If it has been deducted from 620, then I am going to add this. But because this is not deducted earlier, so we are not going to do anything for salary to partner. Always see in the question, if it has written that the salary has been deducted from this profit, then we need to add back that salary as this. But if the question says that no salary has been deducted yet, then we not need to add any salary to partner like this. So in this question, I am not going to treat salary to partner. There is no treatment of salary to partner in this question, but interest to partner is going to be allowed only up to 12%, because if it is exceeding 12%, then we need to add back the 3% part in this question, because 15% has been allowed. But again, question says both things same. We need to add back salary to partners only when it has been deducted from the given profit. And again, we need to add back the excess part of interest if it has been deducted in full before calculating this net profit. So in question, neither the salary has been deducted nor the interest. So if in question it has been given that 15% interest of 115 has been deducted, then I need to only add 3% interest, the excess of 12%, because in this question, nothing has been deducted in regard of interest also. So interest is allowed up to 12%. So I am going to deduct the 12% part of interest will be 1,20,000. So after that, my book profit will be 5 lakh. Always remember just one thing, that if the profit for partnership firm has been given without deducting salary to partners and without deducting to interest to partners, then we are not going to do any treatment of salary to partners to calculate book profit, and we are going to deduct only 12% interest out of that profit. But if it is given in question that salary and interest has been deducted from the profit, then we need to add back the whole salary and we need to add back only that percentage of interest which is in excess of 12%. Okay. So that book profit will be 5 lakh and up to 3 lakh book profit will be, allowable salary will be 270, because 150 or 90% higher will be 270. So I just take a shortcut that the salary will be 270 and on balance 2 lakh, it will be 60%. That is 1,20,000. So allowable salary maximum as per income tax will be 390 and account says it can be 180. So whichever is lower, that means 1,80,000 will be my allowable salary and balance will be my net profit as per income tax. The correct answer is B, that is 3,20,000. You can understand the question like this. In case of partnership firm, there will be two kind of question. In case of partnership firm, there will be two kind of question. If it is given in question that net profit before deducting interest to partner and salary to partner, then what we need to do, we should take that net profit and before deducting less, that means deduct only interest to partner up to 12%. You just need to deduct only 12% interest out of this net profit and you will having your book profit. You just need to do this thing. You need not to do anything with the salary which has been paid to the partners as per account. But if it is given in question that net profit is after deducting interest and salary to partner, then that format which I have given in the summary part of the notes you should follow, which is like this. We should take net profit and add 100% salary paid to partners. So do not get confused in the question. You need to see what kind of net profit has been given. And in that case, we need to add back excess of 12% interest if it has been paid to the partners. Then this will be your book profit. So in some question, in some illustration, you might see that only 12% has been deducted and no treatment of salary to partner. And in some illustration, in some example, you can see that in the solution, 100% of salary has been added back and more than 12% interest has been added back. So that is due to what kind of profit has been given in the question. So you should first see what kind of profit has been given in question. If it is this case, you need to follow this format to find the book profit. If it is this case, you need to follow the book profit like this. After the calculation of book profit, all the solution part is same in both the cases. So in our example, the correct answer was 3,20,000. I hope it is clear. So question number 10, correct answer we just discussed, and that is point number B. Okay, I hope it is clear. So now moving on to our notes from where we have left earlier. Our sheet of notes, assignment number 3. We have discussed over here deduction regarding TDS provisions. And we were discussing partnership. So this format of calculation of book profit, which is in notes, you need to follow this if it has been given that the deduction of interest and salary has already been allowed from this profit. Then we need to follow this. If the question says no deduction has been allowed regarding the salary and interest, then you just need to deduct up to 12% of interest out of that and you will get the book profit. The question now also, the provision also says one thing, which is important for your understanding, that assessment in the hands of partners. So the question says the allowable portion of salary or remuneration or interest in PGBP will be taxable in the hands of partners under the head of PGBP of partners individually. So generally a partner, if you are a partner in a firm, then a partner from a firm generally receive interest on capital or loan, salary from firm, and net profit from firm. So any net profit received from partnership firm is exempt in the hands of partners. All of these three will be shown under his PGBP income. You all know that salary to partner is not salary. It is his business income part, fine? Because in case of partnership firm and partner, there is no employer-employee relationship. So anything which has been received from firm by partner will be shown under his PGBP head. Even interest will be his PGBP income. This interest will not be his income from other source. and of course the salary also, which is received by firm. So these are two taxable things, and any profit received from a partnership firm as a partner is going to be exempted. So now the question arises that suppose there is a partnership firm which has net profit of 5 lakh rupees. Clear? Paid salary to partner 4 lakh as per accounting provision. But allowable salary as per income tax or accounts whichever is lower has come only 3 lakh rupees. So from net profit of partnership firm, we have deducted 3 lakh rupees as salary to partner. Clear? Now, interest to partner was 20,000, and suppose up to 12%, the value came 15,000. So out of the salary of 4 lakh, only 3 lakh has been allowed under partnership firm, and out of this 20,000, only interest of 15,000 has been allowed. So whatever salary has not been allowed, that means 1 lakh is not allowed, and the interest of 5,000 is not allowed. That is going to be the part of net profit of partnership firm already, automatically. But whatever is the allowed portion, that is going to be only shown in the heads of partner individually under his PGBP head. So in this question is 15,000 allowed. Then this 15,000 will be his individual income under his individual head of income, PGBP. And whatever salary is also allowed is going to be taxable under his individual head of income. So as a partner, profit received from the firm is exempted, and whatever salary allowed, whatever interest allowable, only allowable portion is going to be taxable in the hands of partners individually. The disallowed portion is automatically taxable under partnership firm provision. How automatically taxable? I will explain you with the numerical when we are discussing. So just wait for a minute. We will discuss how its disallowed portion is going to be taxable. So the provision says, always remember the allowable portion of salary, etc. is going to be taxable. The allowable portion is going to be taxable. The disallowed portion is automatically, the allowable portion is going to be taxable in the hands of partner, and the disallowed portion is automatically will be taxable in the hands of partnership firm. So everything is taxable. If the partnership firm pay you 4 lakh rupees as salary, out of which 3 lakh is allowable. So 3 lakh is going to be taxable in your hands individually, and 1 lakh is going to be taxable, the disallowed portion, in the hands of partnership firm. So of salary, remuneration, interest in PGBP, profit received from the firm by partner will be exempted in the hands of partners under section 10(2)(a). Okay. So that is the meaning of book profit. You can go through it. The working partner meaning. Now we are moving on to illustration. Illustration number 12 regarding the partnership firm that will help you to understand the provision more clearly. Illustration 12 say that a firm has 7,50,000 as remuneration to partners for the previous year 22-23 in accordance with its partnership deed. And it is a book profit of 10 lakh rupees. What is the remuneration allowable as deduction? So we always find the deductible amount as salary paid as per accounting provision or as per deed, or maximum salary allowable as per income tax, whichever is lower. So in the question, book profit has already been given. So we just need to calculate the amount of salary allowable as per income tax. So if it is 10 lakh rupees, then up to 3 lakh of book profit, 90% or 150, whichever is higher. So higher will come 2,70,000. Remaining 7 lakh, 60% is taxable. That is 4,20,000. So allowable salary as per income tax is 690 and firm has paid 750. So whichever is lower is going to be allowable, and that is 6,90,000. And if we need to calculate the profit of the firm, then we need to deduct 6,90,000. The remaining will be your profit. But in this case, allowable salary is 6,90,000 and disallowed. If the question asks what is disallowable, then that will be 750 minus 690, that is 60,000 will be disallowed salary. So over here 690 is or 750, whichever is less is allowable, and that is 690. Balance 60,000 is technically disallowed. Next question. Rao and Jain, a partnership firm consisting of two partners, reports a net profit of 7 lakh. I told you in question, you always check before deduction of interest or salary or after. So question says before deduction of following items: salary of 20,000 each per month to two working partners. So this has not been deducted yet. Depreciation on plant and machinery 150, not yet deducted. And interest at the rate of 15%, again, this not yet deducted. So I've told you that if the profit has been given without deduction of interest and partner salary, then we need to follow this. We need not to add anything regarding the salary. So this is not applicable. But we need to deduct the interest up to 12%. So the 12% interest calculation will come (15% of 5 lakh. That means 75,000. And if you will find out the 12% out of that 15%, so 60,000 will be allowed as deduction. And of course, depreciation they left deduct. We need to deduct the depreciation also, which is 1,50,000. So after that, our book profit will come 4,90,000. Clear? Now out of this 490, we need to calculate how much allowable salary as per income tax, which is up to 3 lakh. Out of this 490 up to 3 lakh, that will come 2,70,000, and balance 1,90,000, that is going to be 60% of it, which will come 1,14,000. So total allowable salary as per income tax can be 3,84,000, and as per accounting it's coming 4,80,000, because 20,000 for each partner per month. So one partner is 240 and two partner it is 480. So lower will be allowed, that is 3,84,000. So this 340, 384, if I deduct it from this 490 of book profit, remaining will be my partnership income, that is 1,06,000 will be net profit. Now in this question, if I'll ask you what amount is going to be shown as partner individual income. So I've told you that allowable salary and allowable interest will become the part of partner income. So in this question, what is allowable salary? That is 3,84,000 is your allowable salary. That will taxable 50% in partner A, 50% in partner B. So 384 is going to be aggregate taxable. We need to calculate separately. Then 50% of 384. And what is the allowable depreciation? If you see, allowable interest on loan or capital, that is 60,000. So that is going to be taxable as 60,000 in partner's hand. So whatever is allowable under partners assessment, firm assessment, that is going to be taxable in the hands of partners. Where we have the solution in detail, if you want to see 490, and the allowable salary will come 384 or 490, whichever 480, whichever 490, whichever is lower, and that is 3,84,000. Assessment in the hands of partners, of course, allowable salary is going to be taxable in the hands of partners. So that was the provision regarding partnership firm. With example, we have discussed it. Okay. Now let's see if there is any query. Okay, no query yet. Good. So now moving on to our second last numerical important provision, which is going to be very important for your examination. That is expenses disallowed under section 40A under specific circumstances. Very easy section. Not very difficult provision, not very multiple provision. Point number 1, 3, and 4 is one line provision. Important provision is point number 2. So section 40 says that some expenses are disallowed. Like TDS, if not deducted, the expense is going to be disallowed. But these are this section 40A says that expenses disallowed under specific circumstances. That means under normal circumstances, they are generally business expenditure and allowed. But if some business expenditure, which is generally allowed, but if does not fulfill some specific condition, then in that special circumstances, that expenses cannot be claimed as deduction. Point number 1 was that, which I was discussing in MCQ number 8. And I told you that this provision will come later. So this is the provision number point 1, which is talking about that if you are paying any expenditure which is regarding your business to a specified person. A specified person means your relative, etc. The definition has been given. And if it is exceeding the FMV, if I am paying salary to my relative who is working in my organization and I am paying him 10 lakh rupees. But that kind of person I can appoint in my organization for rupees 7 lakh only, but I am paying him 10 lakh. So government says that 3 lakh will be disallowed. You can only claim 7 lakh or up to the market value of that expenditure in your books of accounts as your expenditure. If I purchase from one of my relative goods worth rupees 20 lakh, but the market value of those goods were only 18 lakh, then balance 2 lakh is going to be disallowed as my purchase expenditure. So it's a very simple provision. It just say that if you are going to pay to some specified person, even if you are paying 20 lakh rupees to a stranger for something, some expenses valued 18 lakh only, then this provision will not initiate. You can claim 20 lakh as deduction. But if two conditions should be fulfilled, that payment is to a specified person and it's exceeding FMV. If it is less than FMV, no provision need to be applied. So if it is exceeding FMV, then only the excess amount will be disallowed. Let's discuss this provision one by one. Expenses or payment not deductible in certain circumstances under section 48. First is payment to relatives and associates. And it's a very, very simple concept. Section 48(2) provides that where the assessee incur any expenditure, okay, in respect of which payment has been or is to be made to a specified person. The definition of specified person is given below. So much of the expenditure as is considered to be excessive or unreasonable shall be disallowed by the assessing officer. While doing so, he shall have due regard to the market value, the legitimate needs, the benefit drive, etc. So meaning of a specified person, this is the definition. You can go through it, of course. There's a concept of substantial interest also, and I believe you must have read this concept in basic concept provision in the definition part. Substantial interest means when you have interest in any business more than normal, and we find it out with the percentage as it's been 20% or more. So if you have voting power in any company for more than 20% or up to 20%, then it will be say that you have a substantial interest in that company. For other than company in another organization, you need to check this 20% as per your profit sharing ratio. So first provision was that simple. It has been covered that if you are paying to a specified person any amount which is excess of FMV, then that excess is going to be disallowed. The second point that is important, of course, payment in excess of 10,000 made otherwise than through prescribed mode. The prescribed modes are, of course, through banking modes. NEFT, RTGS, IMPS, check, account pay check, etc. So provision says that if you are going to make any payment in one day to any person in total, and it's more than 10,000, then the whole amount is going to be disallowed. Even if you have paid in a different time of the same day. For example, I purchased worth rupees 50,000 material from a person, and I'm going to pay him 8,000 in the morning, 8,000 after 1 hour, 8,000 later, 8,000, 8,000, 8,000. I have paid him 8,000 6 times in the same day and 2,000 rest balance in the same day. So I have made transactions, 6 transactions of 8,000, that means 48,000, and a 7 transaction of 2,000 rupees in cash. Everything has been in cash. So the provision will implement, the provision will invoke, and it say if you are going to pay any person for any expenditure in same day, more than 10,000 rupees in cash, etc., that is going to be disallowed. The whole expenditure is going to be disallowed. So that expenditure cannot be claimed as revenue or as well as capital expenditure. It's a very important thing to understand that in the same day, aggregate of whole payment will be considered. We have the provision according to section 40A3, where the assessee incurs any expenditure in respect of which payment or aggregate of payment made to a person in a day, otherwise than by an account pay check drawn on a bank or by an account pay bank draft or electronic mode, etc., exceed 10,000. Such expenditure shall not be allowed as deduction. Even if you are paying salary to your staff, there is a staff in your organization, his salary is 25,000. And if you pay that salary 25,000 in cash, same day, then whole 25,000 will be disallowed. You can pay like this: 8,000 today, 8,000 tomorrow, and 9,000 day after tomorrow. So if the day has been changed, then you can make the payment without disallowance. Or if you need to pay your 3 employees, 8,000 salary of 3 employees separately. Mr. A is your employee, B and C, and the salary is 8,000 each. Then you can pay 8,000 to A, B, and C same day, because provision will invoke if you pay same person, same day, more than 10,000. So if the person change or the day change, then this provision will not be applicable. What is the prescribed electronic mode? Does NEFT, etc.? No need to discuss it. The provision applies to all category of expenditure, whether it's revenue or capital, etc. Like in respect of an expenditure of 32,000 incurred by X Limited, 4 cash payments of 8,000 are made on a particular date to one Mr. Y. One in the morning, then afternoon, then the evening, and then later in the evening. The entire expenditure of 32,000 will be disallowed. Okay. So whether it's a capital expenditure, it's going to be disallowed. It's not going to be form part of your capital asset. Under section 43(1), you might remember that is actual cost of asset. There also we discuss it that if any payment is exceeding 10,000 in cash, then that payment cannot form part of your actual asset cost. Okay. And even its revenue nature, the same provision will be applicable. Next, increase limit of 35,000 applicable. So in normal, if you are paying to any person, the limit is 10,000. But if you are paying it to a transporter, if the payee is the transporter, then limit will increase up to 35,000 per day per transporter. For other payment, it's 10,000, and it's for transporter, it is 35,000. Cases where disallowance would not be attracted, if it is related to loan transaction, it does not apply to loan transaction because loan is not part of your expenditure. It's your liability. It won't reduce your profit. Only those transactions, those do have effect on your profit. That is disallowed. So if it is a revenue expenditure or if it is a capital expenditure, it is disallowed because that will claim depreciation, and your depreciation will come into to reduce the net profit. but it's a loan, then that is not going to be disallowed under this section anyway, because loan is technically not a revenue or capital expenditure. For loan transaction, there is separate provision section 269 SST, that's a separate thing. But for PGBP, if you taking loan or giving, if you are giving loan to someone, that then this section will not be applicable, because paying loan in cash won't form part of your profit and loss account. It's not going to reduce your profit and loss account. Okay, but if interest of that loan has been paid in cash, then the provision will invoke. Payment made by commission agent. This requirement does not apply to payment made by commission agent for goods received by them for sale on commission or consignment basis, because such payment is not an expenditure deductible in computing the taxable income of the commission agent. So if I am a businessman and there is a commission agent and he's working on my behalf, and if I am paying cash to him 1 lakh rupees, then go and pay to someone else. Then for that commission agent, he's just an agent. That 1 lakh rupees is not his expenditure. So for his purpose, that 1 lakh cannot be allowed or disallowed. Okay. Now we have some exception of those provision which says that you cannot pay in a same day more than 10,000 rupees to any person, but we have some exception of that. Loan and commission agent is something in which this is not applicable. They are not exception. They are the cases on which the applicability is not possible. But now we are talking about some revenue expenditure and capital expenditure, in which you can pay that in cash more than 10,000 or 35,000. Same person, same day, but still those are not going to be disallowed. So now this is exception. If somebody is asking what are the non-applicability of cases of this section, then we will explain the loan and the commission agent case. But if somebody is asking what are the exception, in that exception we need to write rule number 6DD provision, which are over here. Rule number 6DD, that is exception of section 40A. Okay. As per this rule, no disallowance under section 40A shall be made. Okay. Shall be made even if it exceeds 10,000 in the case and circumstances as specified hereunder. Okay. Where the payment is made to bank. So we need to read in the basic provision, because these are very simple provision. If you are making cash payment to any bank, then this provision is not going to be applicable. Where the payment is made to bank. Technically, what is the logic behind this provision? Government wants to know that if you are incurring any expenditure in cash, then is it a real expenditure or fake? If I write down that I have an employee and I'm paying salary to him 50,000 per month in cash. So is there any employee exist or not? This cannot be found by the department. If I wrote down that I have purchased material of rupees 5 lakh to reduce my profit and I have paid to Mr. A via cash. So department is not able to find that is there really this expenditure incurred or it's just a book entry to reduce your profit. So the concept says if you are paying any expenditure exceeding 10,000 via bank, etc., then that is going to be, government wants to sure this thing that yes, the payment has been transferred to somewhere else. Because through bank account, we can find out that yes, there is a person to which we have paid something. So to find out technically who is the payer and the payee, and is this expenditure actually flows from the payer to the payee. And on the time of investigation, government wants a trail that we can find out who were the actual payer and who was the actual payee. So that's why the provision has been made that the payment should be via banking mode. So through banking mode, we have the account details from which account it has been transferred and into which account it has been received. So we can find those person and can investigate that the expenditure was real or not. So that was the logic behind, that was the intention behind creating this provision. So now you understand why I'm telling you this right now, because for exception purpose, you will understand that if somebody is going to pay any amount in cash to the bank, then we already know who is the receiver, bank. Because if we'll write down that I have paid some amount, 5 lakh rupees to the Punjab National Bank. And if I'm giving this details to the income tax department, then now the department already knows that who is the receiver, bank. So that cannot be fake. We can go and ask to the bank that if somebody has paid you 5 lakh rupees, Mr. So and so that day, so bank can confirm. So we now know automatically the pay. So in those circumstances in which pay is automatically identifiable, in that case, government has made some exception. So if I have a cash of 5 lakh rupees and if I am paying it to the bank, then I can pay to the bank and this disallowance will not be applicable. So you can see in all the exception, there's a common thing that we can track the pay. So that's why those cases is inclusive in these exceptions. So first is where the payment is made to a bank and society and LIC. So you can see that if we say that we made payment to a bank or a cooperative bank or mortgage bank or any society, agricultural credit society or a life insurance corporation. So we know the pay and we can ask them that yes, assessee is saying truth or not. So that's why it is in the exception. Again, if you are making the payment to the government, now you are making the payment to any government department, and if it is payment in cash also, that is going to be allowed because we know who is the pay. We can ask that assessee is saying true or not. Again, where the payment is made by a bank, any letter of credit, a mail, a book adjustment, a bill of exchange by anyhow, this exception is applicable. So the main concept, if you are paying to bank, if you are making payment to government, if you are making to any credit society, LIC, etc. Where the payment is made by way of adjustment against the amount of any liability incurred by the pay for any goods supplied or service rendered by the assessee to such pay. It's an accounting concept that is book entry adjustment. For example, Mr. A and B, Mr. A sells some goods to Mr. B for rupees 1 lakh. And Mr. B provides some services to Mr. A worth rupees 85,000. Understand? Mr. A sold some goods to Mr. B for rupees 1 lakh and Mr. B provides some services to Mr. A for rupees 85,000. Now, in the books of account, if you can see, in Mr. A books of account, Mr. B will be the debtor and a creditor both. Because Mr. A sold some goods to Mr. B worth rupees 1 lakh on credit, and Mr. B provides some services to Mr. A on credit. Payment has not been made yet. So in both books of account, they both will exist as a debtor and creditor. In A books of account, Mr. B will be a debtor of 1 lakh rupees and creditor of 85,000 rupees. And Mr. B books of account, Mr. A will be the creditor of 1 lakh rupees and debtor of 85,000. It's a very simple concept of accounting. There's nothing complicated. So now if they decide that we should write off 85,000 because the common payment is 85,000, balance is just 15,000, what they need to pay. And if that payment is made 15,000 in cash, then only that 15,000 is going to be disallowed. The payment which has been adjusted via book entry of rupees 85,000 is no applicability on 85,000 rupees, only the applicability on that amount which has been flowed actually in cash. That is 15,000. So in this circumstances, if Mr. B paid 15,000 to Mr. A in cash, same day, then only 15,000 will be disallowed. Suppose Mr. B paid 10,000 via online mode, banking mode, and 5,000 only cash on the same day. He paid 10,000 the same day via account pay check, RTGS, NEFT, IMPS, and 5,000 in cash. Then nothing is going to be disallowed because with whatever has been paid in account pay check, etc., is outside the purview. And now the cash payment is only 5,000. So 85,000 is the book entry adjustment. That is exception. 10,000 is via bank. That is not applicability. Only 5,000 is left as an actual cash outflow. That is not going to be disallowed because the limit is only applicable when You cross the amount of 10,000. Okay. Next is where the payment is made for the purchase of. Now, in the exception, I have told you only those cases included in which the pay is traceable, and those cases which are genuine. In those cases, which is not possible to take transfer via any bank mode, etc. And the benefit is given to the farmers, agricultural also for their agriculture produce sale. So for farmers, there is always a soft corner with the government, and they provide some benefit to the whenever we talk about the farmers. So where the payment is made for the purchase of, if you are purchasing goods from a farmer, then you can pay him cash exceeding 10,000 rupees if it is for agricultural produce. So we are purchasing what? Agricultural forest produce, the produce of animal husbandry, fish or fish product, or the products of horticulture or apiculture. To the cultivator, grower, or producer of such article, producer or product. In this case, we can pay payment exceeding 10,000 to the same person, same day. No disallowance will be made. Where the payment is made for the purchase of the product manufactured or processed without the aid of power. That means if somebody is manufacturing something with the help of course, handmade things, then to promote them, government provide that you can pay them in cash more than 10,000. No disallowance will be made. Where the payment is made in a village or a town to any person, and in that village or town there is no bank, exists in that village or town, then you can pay him in cash also, which on the date of such payment is not served by any bank to any person who ordinarily reside or carrying on business, profession, vocation in any such village. Remember, in point number E, the payment was to the farmer for agricultural produce. You can make in cash. But in point number G, the payee is not farmer. It can be any person who reside in that village in which there is no bank served. So there's a difference in it. Okay. Where any payment is made to an employee of the assessee or the heir of such employee or in connection with the retirement, retrenchment, resignation, discharge, or death of such employee. In these cases, you can pay them the compensation in cash, but cannot exceed 50,000 on account of gratuity, retrenchment, compensation, or similar terminal benefit, and the aggregate of such sum payable to the employee or his year does not exceed 50,000. So we have three limit section: 10,000 to everyone, 35,000 to transporter, and now a special provision in the exception is if you are paying to an employee or his legal heir anything up to 50,000 rupees at the time of his resignation, death, etc. for gratuity termination, then still that expenditure can allow reduction up to rupees 50,000 only. Where the payment is made by assessee by way of salary. Now, this technically point number I is not practically that applicable, but it has been written in the section due to because the act is very old. Our act is 1961. So at that time or after that till 1990 or till 2000, it might be applicable. But for today's circumstances, I guess practically it's not applicable. Where the payment is made by an assessee by way of salary to his employee. Suppose employee is working in Delhi, okay, and his employer sent him for some work to any other city. For example, we can say he sent it to Lucknow for temporary purpose, for any business project, etc., for more than 15 days. So employer sent his employee from Delhi to Lucknow for 25 days. And during this 25 days, his salary due. During his 25 days of working, his employee's salary payment date is due. And in Lucknow, that employee does not have any bank account. Then his salary can be paid in cash more than 10,000, same day, same person. Why I was saying that it's practically not applicable? Because now we have CBS system. So even if he has a bank account in Delhi, so the employer can deposit his salary into his bank account in Delhi and he can take out the money from Lucknow or anywhere in India. But because the provision exists in the examination, if it has come, so we have to say that disallowance will not be made due to this provision. So two conditions should be fulfilled. That is temporarily posted for a continuous period of 15 days or more. If he has been in Lucknow for only 10 days, then employer cannot pay salary in cash. In a place other than his normal place of duty or on a ship and does not maintain any account in any bank at such place or ship. Okay. Where the payment is made by any person to his agent who is required to make payment in cash for goods or service on behalf of such person. Where the payment is made by any authorized dealer or a money changer against purchase of foreign currency or traveler's tax. If I need some foreign currency and I'm going to pay cash to that person, the authorized dealer, he will pay me foreign currency. That will automatically be in cash always. It cannot be a bank transfer, or if it is in a cash, then that is allowed in case of only authorized dealer or a money changer. That was section 40 exception. Rule number 6DD. Third is disallowance of provision for gratuity. Technically, all the provisions and reserve under income tax is disallowed. All the provisions and reserve are disallowed. If it has been given in your profit and account, in the debit side, that provision for bad debts or general reserve, evaluation reserve, any kind of reserve and provisions are disallowed except this. This is the only provision which is allowed regarding only gratuity. Section 47 provides that no deduction will be allowed to any taxpayer carrying on any business or profession in respect of any provision or whatever name called, whether it's provision, reserve, or anything, because that is not a real expenditure. As provision or by any other name made by him towards the payment of gratuity to his employee. So, except gratuity, provision, all the other reserve and provisions are disallowed on their retirement or on the termination of their employment for any reason. However, no disallowance will be made as per section 47 in the case gratuity has become payable during the previous. So, if gratuity becomes payable during the year, then only that reserve of gratuity or provision is allowed, except that all the provision and reserves are disallowed. Gratuity payable during the year means that the person for which you have created that reserve or provision has been retired, etc. during the previous year. Then that provision of gratuity, which is payable during the year, is going to be allowed as deduction. We have the summary provision regarding section 40A. First one regarding the FMV provision. Second is for disallowance, that is 10,000, 35,000, same day, same person, etc. You can go through it. Any provision regarding gratuity. And fourth point, which will come later, but I have made the summary provision over here, that is contribution by employers. Contribution by employer to any staff welfare fund for no genuine benefit. If any employer made a fund for staff welfare and contributed and claiming expenditure of that staff welfare expenses, so it cannot be claimed if the benefit of that fund is not genuine. So if AO thinks that that creation of fund benefit is not genuine, that is not going to be used for the purpose of employee actually, then that contribution expenses cannot be claimed as deduction. The detailed provision of point number 4 is below. This subsection has been reduced to curb the growing practice among employer to claim deduction from taxable profit of the business of contribution made apparently to the welfare of employee from which, however, no genuine benefit flows to the employee. In the question it has been given that genuine benefit is flowing to the employee or not. So if it is not flowing, you cannot claim it as a deduction. Section 41. So we were talking about till now regarding the expenditure part, that this expenditure will be allowed or not, that expenditure will be allowed or not. Now we are talking about profit chargeable to tax. As section 29 says, section 28, which is charging section of PGBP, it says any profit or gain arises directly or indirectly for doing business or for not doing business is going to be taxable. That was a normal case. Now we have some specific provision regarding profit of business, regarding those profit or gains which need to be shown under PGBP head, and they are different from normal business activities. This section enumerates certain receipts which are deemed to be income under the head. Deemed to be income, not normal income, they are special income which need to be shown under PGBP head, just like in a case of balancing charge. We discussed the balancing charge provision in which if there is a power generating undertaking, its sale is asset. And if profit arises on that asset, that means the sale consideration is exceeding WDV. Then we need to calculate the balancing charge or terminal depreciation. So terminal depreciation, I told you, will be shown in the debit side of the P&L trading account. And if there's any balancing charge, that need to be shown in the credit side. So that's a special concept. Because generally, whenever you sell an asset, the treatment is in capital gain head, not the PGBP head. But in that case, because that's a special business of power generating undertaking, which using SLM method, only is treatment of balancing charge is applicable in that case. So those special cases which are not general business income need to be discussed over here. First is remission or cessation of trading liability. That's a very interesting case. If there is any trading liability and it has been ceased to exist, then the benefit arising due to that trading liability going to be taxable under your PGBP. Let me give you an example so you will be able to understand that more clearly. Suppose Mr. A running is a business and the previous year 2020-21 he make a profit and loss account and he purchased 100 lakh rupees goods. Suppose all the profit expenses after that the net profit was 20 lakh. Out of this purchase, 15 lakh purchase was on credit. All other purchase of 85 lakh was cash purchase. And this 15 lakh was his credit purchase. So in that previous year, in the balance sheet, his creditor must be showing 15 lakh. Clear? It's a simple accounting concept. So Mr. A has a trading liability of 15 lakh. No, that's not a loan. That's a business liability. So we will say that creditors of 15 lakh is technically a trading liability of Mr. A. Now what happened? Suppose in previous year, 22-23, we came to know that Mr. Creditor, from whom we purchased this goods, has expired. He is no more. And there is no recovery will be done in future from his part. He is no legal heir, nothing. So we came to know that this liability has been ceased. Ceased, that means ended. Now we need not to pay this 15 lakh ever in our life. So that is called remission or cessation of any trading liability. So the question say, what will be the treatment of this 15 lakh creditor? So you can see that we have claimed the deduction of this 15 lakh in our P&L account. And due to this deduction, my profit has been reduced by 15 lakh in previous year 20-21 because that is included in the purchase of this 100 lakh. So the income tax say because now you need not to pay this amount. That's a kind of a gift for you. So if you are not going to pay this liability now, so that will be treated as your income in the previous year under this section 41, that is cessation of your trading liability. Or we can say whatever your profit as per accounting in the previous year 20-23, this session value of 15 lakh is going to be added in your profit and will be liable to tax because you have claimed this 15 lakh as an expenditure, and because now you not need to pay anything regarding that, then you should not claim that expenditure in previous year 20-21. So to rectify the effect of that expenditure, we need to taxable this 15 lakh. In the year we come to know that that liability has been ceased to exist. Suppose that creditor of 15 lakh has been paid and remaining is 7 lakh only in previous year 22-23. Then remaining 7 lakh will be added as your business income in section 41. Understood? It's a very simple thing. Of course, if there is any creditor or any kind of trading liability. If I say there is a loan of 15 lakh you taken from bank, then this concept will be not applicable because you did not claim that loan as your expenditure ever in your P&L account. So if there is any trading liability cease to exist, then that will be your business income in the year in which that liability ceased to exist. So suppose an allowance or deduction has been made in any assessment year in respect of loss, expenditure, or trading liability incurred by A. Subsequently, if A has obtained, whether in cash or in any manner whatsoever, any amount in respect of such loss, expenditure, of some benefit in respect of such trading liability by way of remission or cessation thereof. Somebody was asking me, sir, what is the treatment of recovery of bad debt? That's kind of again a kind of a loss you have claimed earlier, and if it is recovered, again that's going to be taxable. The same way the concept says, or the value of benefit accruing to him shall be taxed as income of that previous year. It does not matter whether the business or profession in respect of which the allowance or deduction has been made is in existence in that year or not. Even you have closed your business also. Still, if there is any recovery of bad debt of earlier year or kind of cessation of liability, that is going to be taxable in the hands of assessee under PGBP. Balancing charge, sale of capital asset of scientific research, section 35 AD, recovery of bad debt, etc. All are the example of this section. We have already discussed sale of sale of scientific research asset. You remember, in which I say the first case which says if it has been sold without using for other business, in that case the cost of the asset or the net sale price, whichever is lower, is going to be taxable as your PGBP income. So that's the example of sale of capital asset used for scientific research, recovery of bad debts, balancing charge, etc. will be taxable under section 41. So I guess that was the last numerical treatment provision we discussed in section 41. Now the provisions are a lot simpler. There is no complexity, or they are theoretical provision. The next is coming, change in the rate of exchange of currency. So cost of the asset. If you make an agreement for purchase of any asset from foreign country and make an agreement that if the rate of exchange has been increased or decreased, that will have effect at the time of real purchase of that asset. For example, if I am a businessman, I need to purchase a machinery from a foreign country, for example, for Australia, and I need to purchase it after 6 months, but I need to make an agreement with the seller that I am going to buy that machine in $10,000. But if the rate of exchange increase or decrease after 6 months, then the increase or decrease in your liability is going to be the part of your actual cost. If it is reduced, if there is benefit, that will be reduced. And if it is any increment, that is going to add in the actual cost of your asset. Very simple, very general provision, simple mathematics. There is nothing like income tax complicated provision in this. This is the very simplest provisions of increment or decrement due to the change in the rate of exchange, section 43A. The section provides that where an assessee has acquired any asset from a foreign currency for the purpose of his business or profession, and due to a change thereafter in the exchange rate of two countries, after this provision, I will see if there is any query, I will answer it, and then we will go for a break. Okay. There is an increase or decrease in the liability of the assessee at the time of making the payment towards the whole or part of the cost of asset, or towards repayment of the whole or a part of the money borrowed. This can be possible also in case of loan taken in foreign currency. So the time of paying the interest or repaying the installment, if the currency value change, your liability can be increased or decreased. Toward repayment of the whole or a part of the money borrowed by him from any person directly, indirectly in any foreign currency, especially for the purpose of acquiring the asset, along with the interest, if any, the following value may be changed accordingly: the cost of the asset, the amount of capital expenditure incurred on scientific research, the amount of capital expenditure incurred by a company for promoting family planning, the cost of acquisition of a non-depreciable asset falling under section 48. The amount arrived at after making the above adjustments shall be taken as the amount of capital expenditure or the cost of acquisition of the capital asset at the case date. This whole section 43A just trying to explain only one thing, which we have discussed many times in accounts also and under income tax provision of PGBP also, that any expenditure up to the put to use of asset is going to be the part of your cost of the asset by whatever reason there was. Now section 43B, that is deduction based on actual payment. That is also a provision. It's a very simple provision which says that there are certain expenditure on which you can claim deduction only if they have been actually paid. So these expenditure, those expenditure which have been mentioned on section 43B, you cannot claim the deduction on due basis, on outstanding basis. No. Deduction can be claimed only when they have actually paid, but the benefit, one benefit has been given. If you have paid these expenditure up to due date of ROI, like in a TDS provision, there was a concept of if you deduct TDS and deposit it up to due date of ROI, then the expense deduction can be claimed in the same previous year. The same concept is here, which says that there are certain expenditure. We are not talking about the TDS on that expenditure over here. We are talking about certain expenditure. These can be claimed as deduction in the same previous year. Even if you have not paid it up to 31st March 23, but if you paid these expenditure up to due date of ROI, then those expenditure can claim in the same previous year. And if it is after due date of ROI, same concept, in the year of deduction made, expenses has actually been paid. Except these expenditure, you can claim other expenses on due basis also. But these expenditure you cannot claim on due basis. These should have been paid actually up to due date of ROI to claim in the same previous year 22-23. But if it has been paid after due date of ROI, you can claim in the next previous year. If it has been paid partially, some part in up to due date of ROI, some part after due date of ROI, then again, the part which has been paid up to due date of ROI can be claimed in the previous year 22-23 and balance in the that year in which that expenses have actually been paid to the pay. Clear? So what are these expenditure? It's a very simple concept. You just need to remember the name of these expenditure. And after that, almost all the provision regarding this is going to be end. Only last provision, stamp duty value, will be there before the theoretical provision start. Let me take the query first, then we will move on after the break on the section 43B provision. So let's see, Vaishali is asking, so disallowed interest and salary of partner, where is showing in partner income tax? No. Only allowable salary and allowable interest will form part of partner's individual income. The disallowed part is automatically going to be added in the profit of the partnership. How it will be done, I will tell you with an example. Do not worry. Okay. If pay more than one person of rupees 10,000 to each, that expense allowed or not. If you are paying 10,000 rupees more in cash to a same person, then it's going to be disallowed. If you are paying more than 10,000 to different person also, like A, B, and C, and you are paying salary to each of them 15,000 separately cash, then 15,000 paid to cash A is also disallowed, 15,000 B is disallowed, and 15,000 C is also disallowed. Okay. Sir, if the cash paid more than 10,000 for medical emergency will be allowed? No. There is a concept which says law has no logic. We have to follow it. You cannot say that under these circumstances, if there is a special case arise. So do this allowed or not? So Act does not say that if there's any medical emergency, then you can pay in cash. No. But in this case, you can, if there's any medical emergency, the Act says it will won't be allowed. But you can go to the court if there's any genuine case. You can go to the court and file an application. In that case, court or assessing officer or the authority can, in specific circumstances, if they feel, then they can allow or not. But as for normal provision, the answer is no. If there is any medical emergency, life emergency, because the section does not talk about it, so it is not allowed. So I think there is no more query till now. So we are moving on for our break. And after the break, when I'll be back, we will discussing section 43B provision, that is expenditure, which is allowed on actual payment basis. And after that, I believe that we are going to cover a lot of provisions of PGP today. And I think might be one section will be left that will be taking in 10 July classes with all the chart presentation we are going to discuss. We'll try to revise the whole provision once again in short, very short. And again, the most important thing, your question which has been given in study. So I'll try to cover all the question in my last class also. So we are going to on a break for 10 minutes and we will be resume after the break. So Welcome back, everyone. So we were discussing the PGBP provisions, and if there's any query, you can of course send me. And now moving on to our section 43B. Okay, tell me one thing. How many of you feeling till now? How many of you feeling that PGBP is a very difficult chapter? If you are feeling, you can write. You can please write and tell me that PGBP is a very difficult chapter. If you feel like that, because I will tell you that it is not difficult. If you change your point of view of seeing this chapter, you will find that PGBP is not that difficult. Why you are feeling it difficult, I'll explain it to you. But if you are feeling that PGBP is very, very difficult, or you are even thinking to skip that topic, please do not dare to do this. Do not think that I will complete all other chapters and let me skip this PGBP head. No, do not try this at home or examination center or anywhere in your life. Okay. This is the most important chapter of income tax in intermediate level also and in final also. Like capital gain and PGBP both are the backbone of this DT or income tax chapters. These are the most practically usable topic of also, of course. So please, if somebody is feeling that PGBP is difficult, then tell me, because I'll tell you there is two things. So after that, you understand that yes, it is not difficult. I promise that when we will complete our chapter, session number 5, all of you will feel that yes, it is not difficult. Why you are feeling difficult? I can explain you. Okay, so Arshita is saying it easy, sir. Bhumika is saying, sir, not difficult, but lengthy. Correct, Bhumika. That means you are technically understanding the problem. That yes, it is not difficult, it is lengthy. And it's very good, but I wanted somebody should say that yes, it is difficult. So I am going to explain why you are feeling it's difficult. Nobody is saying it's difficult till now. Somebody should say, if you are feeling it's difficult, tell me. Because only of two reasons you might be feeling it's difficult. First is very correct. Bhumika is saying it's not difficult, it's lengthy. So what happened when we think, God, we are reading this topic, assignment number 1 of PGBP, now second, now third and fourth, any topic of any subject. You only in two situations feel it is difficult when it is lengthy, of course. Because from last 4 sessions, we have gone through so much of provisions. From depreciation, from charging section, then we move on to terminal depreciation, balancing charges, then TDS provisions. Then after that, section 36, other deductions, then 43B, we yet to discuss, then section 40A, then the provision regarding scientific research, section 35, AD, specific business, even unabsorbed depreciation was here, even the cash payment provision we just discussed today, that is here. So there are lengthy provisions. But remember one thing, in the same question, all provision cannot be asked. If the all provision need to be asked in a single question, that question should weightage more than 50 marks. That is not possible because maximum marks question will be around 12 or 15 marks in an examination. So this is something you should understand, that all the concept, all the provision is not going to be asked in the same question. So first of all, you should get this thing that you need to learn all the provision, but not going to solve each and every provision in same question. Examiner can ask any question out of those all provisions. So we need to learn each and every provision with the same intensity, with the same understanding. But in a single question, all concept cannot be asked. First of all, this thing. Now, if you're feeling it difficult, PGBP is not hard chapter for me after your lectures. Okay, Rajiv Kumar, you made it easy to understand it, and even provision easy. PGBP needs time. So we have only 5 sessions. If I would have been given like 10 session or 8 or 9 sessions, so I can make the diagram or chart with every section I teach you. So that is really easy. So now we will discuss the chart in our last session, but if it is possible, if I would have more time, because chart needs time, and I need to make chart with the provision always. But because of short of time, if we are going to do this kind of practice, so we won't be able to complete our chapter. So if the chart presentation I've already made for you, That we will discuss, and after that you will find out that yes, there is no single provision which is difficult. The difficulty is about the length. That's why we need to make short notes. If anybody of you are feeling that it's a difficult topic, then you should try to make short notes of every section. What I have already done for you with kind of diagram or charts, what we are going to produce before the last session, that's a kind of a short notes. Of course, you can take help of it, or you can make yourself short notes also. So there is no single provision which is difficult. No single provision which is difficult. It's just the problem that the length is too much, because the chapter is consisting of so much of provisions. Now, second thing. So the length is the problem. And the second problem, that we did not yet solve a single question with the provisions technically the way it is going to be in your examination. So that is going to be discussed in our last session. And I promise to everyone, if you revise all the provision we have discussed yet, and then if you are going to join the last session class, and where we are going to discuss all the questions or test your knowledge part from your study material, I promise every one of you, most of you, I can take the responsibility of 90 to 95% students, that those are sincerely studying this or taking these classes and sincerely reading the notes, will find that PGBP is technically very easy in comparison to other chapters like salary and capital. It's very easy because we just need to add something, we just need to reduce something, or we do not need to do anything with something. But the concept, the problem is, it's huge, it's gigantic, it has a lot of provision, and we need to remember them and trust your brain. This is so powerful that scientist says that this can remember each word of any book in this whole world. Your brain has that kind of memory and power that you can learn all the books whatsoever, howsoever, wheresoever in this whole world. With each word, every book has. You can learn that. So just believe in your brain that what is this? This is just a chapter. This is just a subject. So generally, when you are till your 12th class, you almost study, or you give almost 9 to 10 hours to your study. Because in college or school, you go to the school for like 6 or 7 hours, then you tuition 2 or 3 hours, and then you study time 2 to 3 hours. So generally, you are devoting 10 to 12 hours for your study when you are till 12th, from like class 1 to like 12. My daughter is in class 5. So I'm seeing her, she's like 6-7 hours in school, then 1.5 hours tuitions, then after 2 or 3 hours of your study. So technically from class 1 to till class 12, we're devoting our like 10 to 12 hours for your study purpose. You are not even given that time in your CA group 1 studies. So we need to give, if we are going to give that time or less than that, you are able to clear this group or any group very easily. So moving on to our notes. So now section 43B, deductions based actual payment basis. So I've explained to you earlier also before the break that there are certain expenditure which are going to be allowed only if they have been paid up to due date of ROI in a section 139(1) in the same previous year, otherwise in the year in which the payment will be made. Those expenditures are: the following sums are allowable as deduction only on the basis of actual payment within the time limit specified in section 43D. Any sum payable by way of tax, duty, cess, or fee, by whatever name called under any law for the time being in force. We are not talking about the income tax over here, because income tax has been specifically excluded earlier. So any sum payable by way of tax. Tax means over here is indirect taxes. Indirect taxes. What is indirect taxes we are talking about? Duty. It's not custom duty, because custom duty already included in indirect tax. The duty is stamp duty. The duty we need to pay to the government. Stamp duty at the time of registry, etc. That kind of duty means duty over here. Cess, that means indirect taxes. Cess we are talking about, or fee. Fee means when you are paying fees to your advocate or your chartered accountant, that fees we are not talking over here. The fee over here means fee under any law. By whatever name called, under any law. So we are talking about all the four things which is under law. That means in which the pay is government. Like indirect tax we are paying to government, stamp duty we are paying to government, cess is we are going to pay to government, and like fees like municipal fees, like municipal tax, court fees, etc. So this fee is not advocate fees, CA fees, because that fee is under a contract between two persons. And we are talking about the fees, cess, duty or taxes under any law. So these four terms have different meaning: taxes, duty, cess or fee. Got the difference? Good. Second, so government says if you need deduction from us, then first of all, any expenses on duty, tax, cess or fee will be allowed only when you actually paid it. You cannot claim on due basis. Okay. Any sum payable by assessee as an employer by way of contribution, that is employer contribution to any provident fund or superannuation fund or gratuity fund or any other fund for the welfare of employee. Now it is an interesting thing regarding this fund provision. We already discussed in section 36 also. So why 36 also talking about the fund, and again we are discussing about the fund. So let me clear that confusion. Okay, so payment to approved fund. For example, there is Mr. A who is an employer, and there is Mr. B who is employed. Mr. A paid to Mr. B 10,000 rupees or say 1 lakh rupees per month as salary. Suppose. Okay. And because there is a government requirement to deposit provident fund into the account of Mr. B, so suppose 15% deduction from Mr. B's salary has been done by Mr. A. Because government says if you are having an employee and you are paying salary to him, then 15% from his salary, 15 or 10 or 12, whatever is the requirement, a certain amount should be deposited to the provident fund. So that amount we will deduct from the salary amount of Mr. B. So Mr. A will do what? He will deduct 15,000 from Mr. B's salary and will pay him 85,000. So Mr. B is going to technically receive 85,000 as salary. This 15,000 is going to be deducted and deposited. We are talking about this 15,000 value, okay? By employer in employees provident fund account. So this is technically is going into the employees other concept kind of a bank account, which is government provident fund. So this is called employee contribution. This 15,000 is called employee contribution. You must have read it in salary head also. So I have also explained to you that when this contribution is received by employee, it will be shown as his income in the credit side. I explained in last session also. And if employer deducted and deposited this up to the due date of that fund, deducted and deposited up to due date of that fund, then this 15,000 can be claimed as deduction. So that deduction has been explained in section 36. That was employee contribution, which has been deducted from employee salary and need to be deducted and deposited by the up to the due date of that fund. So whenever this amount has been deducted, it will be shown in the credit side of employer, and when the deducted and deposited up to due date of ROI, deduction can be claimed. Okay, let me ask you a question because you all have studied the salary concept. Let me ask you a very, very simple question and I expect a correct answer. Because Mr. B received 85,000 as salary in this example, so you need to tell me one thing. What amount should be or will be going to be his salary income? We are talking about for Mr. B, not Mr. A. So I am asking you the salary provision. Mr. B received 85,000 in his bank account. So what salary will be shown for income tax purpose in his salary account? 85,000 or 1 lakh? You need to answer me this. I am waiting for your responses. Let's see. You know or not. So if Mr. B is receiving 85,000 out of rupees 1 lakh, because out of 1 lakh, 15,000 has been deducted by the employer and deposited to his employee provident fund account, which he will receive later with interest or at the time of retirement, etc. So what we will show as a taxable salary in the hands of Mr. B in this example, 85,000 or 1 lakh. Let me see. Abhay is saying 1 lakh. Okay. Anyone else? It's 85,000 or 1 lakh. Just give your answer, whatever your brain says. Okay. Just remember, recall the provision and then answer. If you're recalling the provision, the answer will be most probably correct. Momika is saying 85,000. Rajiv Kumar is saying 1 lakh. I need more answers. Let me see how many of those are not sleeping. How many of you is arise, awake, and stopping not till the goal is achieved. So the correct answer is, of course, 1 lakh, not 85,000. And our salary head, we will show 1 lakh because the concept says, charging section 15 says, it's due or received. Whichever is earlier, or for numerical part, we can say higher. So because the salary was 1 lakh, received only 15,000 or receive only 85,000, taxable will be 1 lakh. Even if you did not receive anything and it's due 1 lakh, then still you need to taxable at 1 lakh. That was salary part. I don't know why I'm discussing with you, but it's good that you are giving correct answer. Most of you are. So we were saying about this concept. So payment to approved fund has two parts. One is called employee contribution, which is under section 36. This was the concept. So 15,000 will be allowed as deduction under section 36 if this has been deducted and deposited up to due date of that fund, whether it's gratuity fund, etc. Now, under the concept of salary, it is requirement that whatever amount will be deducted from employee salary, same equal contribution at least should be done by the employer. So I assume 16%. He can contribute more than that, but he cannot contribute less than 15. So suppose in this example, 16%, that means 16,000 now need to be deducted and deposited. Not deducted automatically because it should be deposited by the employer himself. Need to be deposited by Mr. A to employee provident fund also. So 15,000 need to be deducted and deposited up to due date of fund. Then deduction can be claimed only, otherwise it will be lapsed. But we are talking section 43B. 43B talks about employer contribution. For example, in this example, we are talking about the 16,000. So we are reading this provision. This has already been discussed. But why I am telling you over here? Because you might get confused that we have already discussed the provident fund concept in section 36. And sir is again teaching us a different provision for under section 43B for contribution. So they both are different contribution. 36 talks about employee contribution. 43B talks about employer contribution. So this deduction can also be claimed under PGBP 16,000, but the 16,000 should be deposited up to due date of ROI. This is the difference under section 139(1). So employee contribution should be deducted and deposited up to due date of fund. Then only you can claim deduction. That's a section 36. And employer contribution can be claimed as deduction because it falls under section 43B if it is deposited up to due date of ROI. So 16,000 can be claimed if deducted, deposited up to due date of ROI. 15 can be claimed if deducted, deposited up to due date of fund. So both things, now you might be understand that what is the difference between section 36 contribution and 43B. They both are discussing with separate contributor. 36 is for employee contribution. We have discussed the provision over there. And 43B is for employer contribution. I did not discuss with the help of diagram this concept in section 36 because till that we were not aware of section 43B. But now you know there is a 43B. It's talking about employer contribution. There is section 36, which also talk about the contribution, but that is regarding employee contribution. I hope it's clear now because it's quite interesting provision. Okay. Next, moving on to the provision. So point number B is always remember it's employer contribution. I specifically mentioned it over here also, so you not might get confused. Okay. Any sum payable by the assessee as an employer by way of contribution. Bhumika is asking, sir, salary will be taxable after employer's contribution in case of PA. In case of employer contribution, there is a specific provision under salary head up to 12% of salary will be exempted. Balance will be or excess will be taxable under employee head. I am not discussing the salary concept because you have already read that topic. I am talking about the deduction claim. So whatever it will be your employee contribution, that is going to be allowable as deduction. Whatever is your employer contribution, that is going to be allowed as deduction if they fulfill the respective section requirement. Bonus or commission for services paid to employees. So bonus or commission if you paid to employee, that is going to be allowable as deduction if it has been paid. Okay. Or any sum payable by assessee as interest on any loan or borrowing. So point number D, E, and F, all three talks about the interest. From wherever you have taken the loan from approved organization, if you have taken loan from any approved organization, financial corporation, NBFC, bank, etc., then interest deduction can be claimed only when interest has been actually paid. You cannot claim interest deduction on due basis. So kindly read point number D, E, F. There is nothing complicated. They just talk about the interest if it is taken from any approved organization, can be claimed as a deduction. Any sum payable by assessee as an employer in lieu of earned leave of his employee. We are talking about the leave encashment. That is also part of salary. So salary and if there's earned leave, then you have to pay to get the deduction of that earned leave. So if it is not paid, you cannot claim the deduction. Any sum payable by assessee to the Indian Railway for use of railway asset. If you are booking tickets via railway, then the deduction can be claimed only when it has been paid. For the purpose of claiming deduction. Now you can see the point number A to F is talking about that you have to pay if you want a deduction. But there was nothing like it was saying that you have to pay till due date of ROI. Now this paragraph is talking about this for the purpose of claiming deduction in the relevant previous year in which the expenditure is incurred, the above sum have to be paid by assessee on or before the due date for furnishing of the return of income. So this is applicable on all the points, point number A to H. The deduction can be claimed in the same previous year if you're going to pay that expenditure up to due date of ROI. Otherwise, it will not be lapse. You can claim it in the time when you will pay it. Example, an assessee may collect GST from customer during the month of March 23. However, in respect of such collection, he may have to discharge the liability only within, say, 20th April 2023 under the GST law. The explanation covers these types of liability also. Consequently, if an assessee following accrual method of accounting has created a provision in respect of a liability, the same is not deductible whether you are following mercantile accounting or cash system. Point number A to H deduction expenses can be claimed only if they have been actually paid as per the due dates. Illustration 1, Hari, an individual, carried on the business of purchase and sale of agricultural commodities like paddy, wheat, etc. He borrowed loan from Andhra Pradesh State Financial Corporation, an Indian bank, and has not paid interest as detailed hereunder. So Hari having an interest liability for previous year 21-22 and 22-23 from Andhra Pradesh State Financial, 15 lakh. This is interest. This is not loan. This is interest liability. And from Indian bank, it is 30 lakh rupees. Both banks, while restructuring the loan facility of Hari during year 22-23, converted the above interest payable by Hari to them as a loan repayable in 60 equal installment during the year 31st March 23. Hari paid 5 installment of APS FC and 3 installment to the Indian bank. Now Hari wants to claim whole expenditure of interest as deduction. Now this is not possible because interest deduction can be claimed only when it has been paid. If it has not been paid, you cannot claim this deduction. So let's solve this question. So bank does what? Bank says the whole amount of interest, we are making installment for it in 5 years. That means 60 months. So per month installment for first case was 25,000, out of which he paid 5 installment in this previous year. That means he actually paid only 1,25,000 for Andhra Pradesh, and for other bank, the liability was 30 lakh. Each installment will be now 50,000. And he paid only 3 installment of this. So that will be 1,50,000. So he can only claim interest deduction of 125 and 150 in his previous year 22-23. That means assessment year 23-24. So where is the solution? Again, the theoretical thing is so much. You need not to write so much for your explanation. You just need to explain the basic, the correct provisions in short also for examination, depending upon the weightage of the question. So 15 lakh is like 125, 5 installment paid, 3 installment paid, total amount eligible for deduction only is 2,75,000. Now the next section, which is regarding stamp duty value. There's a same question. There's the same provision, the same provision, just like twins, under section 50C of capital gain regarding this provision. And the same is over here under section 43CA for business purpose. So if you have a building, if you have a land or building, so it might be your stock in trade or it might be your capital asset. So if your land and building is your stock in trade, then section 43CA is applicable. At time of sale, the sale consideration will be calculated as per section 43CA provisions. Remember what I am saying. If you are dealing in buildings, if you are a builder, if your buildings are your stock in trade, then at the time of sale, PGBP provision will be applicable and the sale consideration will be found out as per section 43CA. And the same thing is under capital gain. If your building is your capital asset, not your stock, it's a capital asset, then at time of sale, the sale consideration for that capital asset, which is going to be taxable under capital gain head, will be found out as per section 50CA. So because I am going to teach you section 43CA under PGBP head, so I won't repeat this section in capital gain, that how to find out the value of a capital asset under capital gain, because they are exactly the same. Just the assessee has been changed and the head. If that is your capital asset, capital gain provision will applicable, but the sale consideration will be find out same. The section name is 50C. And if it's your stock, then exactly same provision applicable under section 43CA, but under PGBP head. So because I am going to teach you capital gain topic also, so I won't discuss section 50CA at that time. So we will have our separate time for that. So now stamp duty value of land and building. This is only applicable in case of land or building or both. To be taken as the full value of consideration in respect of transfer, even if the same are held in the transfer as stock in trade. So what is the concept? Let me explain you with the help of a chart. That will be really easy for us. So section 43CA says there is a land and building as your stock in trade, and if it is transferred, then the sale consideration will be as per section 43C. I hope it's clear. It's not difficult. It's not numerical also. It's very theoretical kind of provision. It says there will be 3 different situations. First of all, there will be 3 different situations which say if stamp duty value exceeding 110% of your sales consideration as declared by you. For example, you are selling your building and you say sale consideration is 100 lakh. And that building government value, circle value, or we say it stamp duty value. If it is question is given, stamp duty value is 130 lakh. So if the stamp duty value is exceeding 110%, that means 110% of this value. That means 110 lakh. So if your stamp duty value is exceeding the 110% value of your sale consideration, in that case, sale consideration will be, it's very simple, stamp duty value or sale consideration declared by you, whichever is higher. So as I can see in the above example, that can be 130 lakh. If you are saying I sell this property 100 lakh, but government will take the sale consideration for the purpose of income tax will be 130 lakh. If it is does not so, if stamp duty value does not exceed 110% of sale consideration. In that case, it's very simple. Sale consideration is equal to as declared by assessor. For example, if sale consideration was 100 and stamp duty value is 105 lakh. So it does not exceed 110% of declared values. In this case, sale consideration will be what you have declared. That will be 100 lakh. The higher concept will not be applicable. Third, now there is a genuine problem like what happened. Sale consideration, stamp duty value exceeding sale consideration 110%. But assessee say, for example, stamp duty value is 140 lakh. You are saying sale consideration is 100 lakh. But if assessee proves that the market value, fair market value is actually 100 lakh. Actually, fair market value is 100 lakh. That's why he is getting only 100 lakh for the sale of that property. So he needs to prove that 100 lakh, that means the sale consideration is lower than stamp duty value because of the fair market value. So because fair market value, if it has been proved that the market value is actually less than stamp duty value, and because of that, I am receiving only that value. So in that case, provision says, now the sale consideration will be stamp duty value or FMV, whichever is lower. So in this example, 140 or 100, whichever is lower, will be your sale consideration for the purpose of section 43CA. So provision says very simple concept that if stamp duty value exceeding 110%, then higher will be taken. If it is not exceeding, then the sale consideration is declared. And even if stamp duty value exceed the sale consideration, but if you prove that my actual FMV is equal to the sale consideration, then the sale consideration will be technically your FMV. That means the lower concept will be applicable. It happens in case of like flat system. If you are building, then the ground floors or first floor having high market value, but the top floors in some cases have lower value. Market value is lower. But government calculate the circle value or stamp duty value equal for all floor. So in that case, it might happen that might be your top floor or any other floor having less market value, but the government circle value is as per the ground floor. So in that case, you need to prove that actually I am receiving less value. The market value is less than the stamp duty value. Then third concept will be applicable, provided this FMV is not disputed. It's not disputed. And the case is not rest in any court, etc. If this case is already in some court, etc., we have to wait until the decision of the court. So this is the concept of section 43CA. In all the three cases, one common provision also there. One common provision says that the stamp duty value, generally we take the stamp duty value at the time of registry. But there is exception which says a stamp duty value can be taken now at the time of registered agreement. Generally, when we sell or transfer immovable property, then first of all, a registered agreement has taken place in which we show that we are taking advance for that property, 5 lakh, whatever it is, and the remaining payment will be paid at certain time, at time of registry with the check value, etc., etc. Details has been given. So registered agreement always executed before registry. So if there is no registered agreement, then the stamp duty value will be taken at the time of registry. But if there is a registered agreement, and in this registered agreement, payment has been received via checks, then the stamp duty value at the time of this registered agreement can be taken. So the stamp duty value can be taken at time of registry or at the time of registered agreement. They both have different. But in the registered agreement, the payment should be received via check. That should be mentioned in that. So in that case, we take the stamp duty value at the time of registered agreement also. So we have a lot of example for this also in the study material, and we have the detailed provisions also, what we are going to discuss via study now or notes. So you might understand what we are talking about. Section 43CA. Section 43CA has been inserted as an anti-avoidance measure to provide that where the consideration for the transfer of an asset, being land or building or both, is less than. Generally, people do what? They actually shows the real consideration less than the stamp duty value to reduce their tax liability. But now with the help of this provision, you actually need to declare your sale consideration at least up to the stamp duty value which has been decided by the government, except in the exception that stamp duty value does not exceed 110%. So 10% variation is allowed, and then that FMV is actually less than the stamp duty value. So however, the stamp duty value does not exceed 110% of the consideration received. In that case, that consideration will be taken. Point number 2, where the date of agreement fixing. This point talk about the date of agreement fixing the value of consideration. For the transfer of the asset and the date of registration of the transfer of the asset are not same. So date of registry and date of agreement is different. Then we can take the stamp duty value at the time of date of registered agreement. If the checks detail has been inclusive and has been disclosed in that agreement. The stamp duty value may be taken as on the date of the agreement for transfer instead of on the date of registration. For such transfer, provided at least a part of consideration has been received by way of account pay check or RTGS, etc. The provision says the assessing officer may refer the valuation of the asset to a valuation officer. If the FMV is less than the stamp duty value, then we need to find the real fair market value. For that purpose, the case can be referred to a valuation officer who will find out the real fair market value. And if the fair market value is less than stamp duty value, then that fair market value will be our sale consideration. This can be done if that is not any dispute or the case is not decided by any appellate authority or court, etc. You should go through it, read it, the provisions. I'm going to discuss this numerical with you, so you will understand how to find out the value. Okay. So the question says, first column says date of transfer of land and buildings. That is date of registry. That is 1st September 2022. Actual consideration 100 lakh. 10 lakh received by account pay check on 1st July 22. So what was on 1st July 22? Third column say that was the date of agreement. So date of agreement was on 1st July 22 in which account pay check has been given. So for the purpose of stamp duty value, now we can take the stamp duty value at the time of registered agreement. That was 120. At the time of registry, it's 130, but we will skip it because payment has been received in check at the time of registered agreement. And at the time of registered agreement, the value is 120 lakh. So in example, for me, stamp duty value is 120 lakh. That will be taken for comparison. 100 lakh is my consideration. Stamp duty value is more than 110% in this case. So because stamp duty value exceeding 110%, there is no FMV is given in question. So now for the purpose of sale consideration, first case of the diagram will applicable. That means sale consideration will be stamp duty value at the time of agreement or as value declared by you. That is 120 or 100. So what will be my 43 CA sale consideration? That is 120 lakh will be taken. In remarks, the explanation has been given. You can see that from the remark. Next question. Now again, check this. If you will see, that is registry is done on 1st September 22. 100 lakh received by him on cash. So because at the time of agreement, there is nothing received on by way of check. So in that case, we cannot take. So now this value, stamp duty value, is irrelevant because it has been received in cash. So this stamp duty value is irrelevant because it is at a time of register agreement. Now we will take the stamp duty value at a time of registry, that is 130 lakh. Now the sale consideration, if you can see, the stamp duty value is again more than 110% of the consideration. So again, stamp duty value or consideration, whichever is higher, will be our consideration under section 43CA. Next example. Now example 11 says, in the example, first of all, you should find out that the stamp duty value should be taken at the time of registry or registered agreement. Now again, registered agreement has been done on 1st July and account pay check 10 lakh rupees has been given. So now we will take the stamp duty value at the time of registered agreement. This registry value is irrelevant now. So that is 109 lakh. And if you can see, that is less than, that is not more than 110% of consideration, which is 100 lakh. So stamp duty value should exceed at least 110 lakh, but in question it is not exceeding. And if stamp duty value is not exceeding 110%, then we can take this value as our sale consideration under section 43CA. Okay. In the remark section, the answer has been explained. But if you will read the diagram, what I have told you, then you can easily find out what will be the correct answer. And in the examination also, you can write it down like this, that this condition is fulfilled. So this will be our sale consideration. Last example of this. Okay. This is last example, I guess. Let's see. Again in question, first of all, I told you should understand what value should be taken because the payment at time of agreement has been received in cash. So the value of stamp duty value at the time of registered agreement is irrelevant. Now we will solve it with the help of this value. And again, you can see it's more than 110%. So higher will be taken, that is 130 lakh rupees. So this is the same thing what I was trying to tell you after the break. But when we read the provision, we think it's a difficult provision. But when we solved it with the help of an example, when we implement it into a question, then you understand it was not that difficult. So might be because PGBP is a huge topic. So might you think how I'm able to solve the full question? I promise when we will solve question in our 5th session, you will find out PGBP is one of the most easiest topic in comparative to salary, capital gain and PGBP. Okay, not in comparison to residential status. It has huge provision. You have to learn them. Once you have learned them, you are easily able to solve them. Okay. That was the last example for assignment number 3. So let's see if there's any query, then we can take it. Vaishali is asking, sir, employer percentage is defined? No, it will be given in question. It is defined that employer cannot contribute less than the amount of deduction from employee. So whatever be the contribution amount, that will be given in question. Okay. How is employee contribution relevant in PGBP? I told you that whatever employee contribution is deducted by employer need to be shown in the P&L credit side first. In 15,000 we were talking. And if the employer deposit that amount up to the due date of that fund, then the 15,000 can be claimed as deduction by the employer. So this is the relevance of employee contribution under PGBP. Okay, so that will be a nil effect. If you receive, it will be in credit side. If you deposit, it will be in debit side. So there will be nil effect. But if you are not able to deduct it and deposit it up to due date of ROI in case of employee contribution, then it is a problem. Then it will remain 15,000 in your credit side on which you have to pay tax from your own pocket. That's a dangerous thing. So most of the employer deposited up to the due date of the fund. So now we have our assignment number 4, that is last assignment. I have already uploaded the notes also for this. 2, 3, and 4. This is our assignment number 4. This is the last assignment. After that, after this assignment, only the question assignment will be left. This is 4th assignment, and here's a quotation. The only time success occurs before works is in the dictionary. So because you all know that success before work comes in dictionary only before, because alphabet W is later than the S. Except the dictionary case, only success will come after the work. Okay. So remember, there is no elevators for success. There is no elevator to success. You have to take the stairs and work hard. Okay. So now the theoretical provision left, there is no numerical provision. There is section 44A. That's a small numerical concept. That is presumptive taxation scheme. Otherwise, there is general theoretical provision. And I prefer that if you are able to read them yourself also, I'm just giving you a hint. Compulsory maintenance of accounts, section 44AA. Maintenance of books of accounts and other documents by notified profession under section 44AA. Okay, fine. Let me help you in also this. I have already made the diagram for this also. And this is theoretical. I'll just tell you the diagram and then you should go to the provision yourself. So we are talking about the cases in which when we need to maintain books of accounts. Everybody who is running a business or profession need to maintain books of account, but we are talking about prescribed books of accounts or not. So there are certain books of account that is prescribed under income tax. Rule number 6F discuss about it. What are the prescribed books of accounts? So if you fulfill the condition as we are going to discuss, then you have to maintain prescribed books of accounts. And if you are not fulfilling these conditions, still you have to maintain books of account, but not prescribed. You maintain books of accounts that assessing officer, if wants to calculate your profit, then he will be able to calculate that profit. So we are discussing that is compulsory maintenance of books of accounts, or we can say specified. Okay. Rule number 6. So as I told you, everybody needs to maintain books of account, but specified books of accounts maintained by whom? This we are going to discuss. Section 44. There are 3 categories of person. Those need to maintain specified books of accounts on fulfilling of certain condition. First is, that is notified professional. If you are a notified professional like doctor, chartered accountant, company secretary, interior designer, engineer, etc., here's a specific list. It is in the notes. So if you are running a notified profession, then you need to maintain prescribed books of account if your gross receipt exceeding 1,50,000 in all the 3 years preceding previous year. We are studying previous year 22-23, that who need to maintain compulsory books of account in previous year 22-23. So this point says that if you want to know that you need to maintain books of accounts in previous year 20-23, then you need to check the last preceding 3 previous year, 21-22, 20-21, and 19-20. So in each year separately, if your gross receipt is exceeding 1.5 lakh, 1.5 lakh, 1.5 lakh. In all of these 3 years, if your gross receipt is exceeding 1.5 lakh, then you need to maintain specified books of accounts in previous year 22-23, irrelevant of the gross receipt of previous year 22-23. So you need to maintain previous year 22-23 books of accounts if in the last 3 years in every year you are having a gross receipt exceeding this. This is for existing business. And if it's your new business, if gross receipt is likely to exceed, if we think it's likely to exceed, that means, for example, in April you earned 20,000 gross receipt, in May you earned 20,000, that means now your 2 months gross receipt is 40,000. So if this trend is ongoing, then your finally gross receipt will be 2,40,000. So if you think that your gross receipt will exceed 1,50,000 in the year of starting of a business, then also you need to maintain books of accounts. So for existing business, you need to check this condition. For new business, you need to check this condition. If you are running a notified profession. That was case number A, we can say. Case number B covers those person, any business, any kind of business, and non-specified profession. Those profession, those are not specified in A point. And if you are an individual and HUF, if you are running a business, if you are an individual HUF, or if you are running a non-specified profession and you are an individual HUF, then you need to maintain books of accounts if you fulfill these conditions. For existing business, for new business. For existing business, if your income exceeding 2,50,000 or your sale exceeding 25 lakh. If you fulfill any condition in any of three preceding previous year, like for A case, 1.5 lakh should exceed in all three preceding year. But for B case, it says, if you want to know that you need to maintain books of accounts in 22-23, then you need to check this condition in any 1 year. Remember, any one. In this, all 3 years, receipt will be more than 1.5 lakh. And it says, if any of this condition has been fulfilled for any 1 year in the preceding 3 years, then you need to maintain books of account. So this condition is dangerous because you need to fulfill only one condition in any one of the year. And in the first case, A case, you have to fulfill the 1.5 lakh condition in all the three preceding previous year. Okay. And again, for new business, same condition. If income likely to exceed 2.5 lakh or if sale is likely to exceed 25 lakh, then you need to maintain specified books of accounts. The last point is for others. Others means all business and non-specified profession except individual edge. That means if you are running any business as a partnership firm, as a company, etc., if you are running any non-specified profession as partnership, company, LLP, etc., then the C condition will be applicable, which is similar to case B. Just the limit has been changed. Everything else is same. If this is an existing business, so now there is 1,20,000 in place of 250, and sale place is 10 lakh in place of 25 lakh. If it's a new business, if likely to exceed 120, or sale is likely to exceed 10 lakh. Again, in any of 3 years, same concept as B. So B and C does not have any difference except the amount. Where there is 2,50,000 in B case, there is 120 in C case. If there is 25 lakh in B case, then in C case, it's 10 lakh. All other provisions of B and C concept is same except this. So these are the cases in which you need to maintain books of accounts. We have more case also, that presumptive taxation scheme. Case number D, you do not, if you are showing your income lower than under section 44A case. What is section 44A? We will discuss it later after this provision. But for time being, if you are falling under section 44A, there is a certain income you need to declare as per provision. What is the provision? We will discuss. So if you are showing your income lower than 44A specified income, then you need to maintain books of accounts. Same way, section 44 AD. If you are showing your income less than a specified limit, then you need to maintain books of accounts under section 44 AD or ADA if your profit is exceeding 2.5 lakh rupees. So section 44 AD concept, do not bother about it because I will separately tell you when we will be discussing this section 44 AE and AD when to maintain books of account, or you will be able to understand automatically when we will discuss section 44 AE and AD provision. For time being, you should just understand this chart, what I explained to you. Okay. Here are the provision, and now you have to read these provisions. These are completely theoretically. First, go through the diagram, the chart concept, and then you can read what are the provision. Exactly the same as being copied over here. The meaning of a specified profession. What are the prescribed books of accounts? All the limits are same. I have already discussed with you in the chart presentation. Why? We can solve it also now. We know there's a person carrying on profession as a film artist. Let me tell you, film artist is a specified profession. It has been included in the specified profession. In the notes, if you will read it, you will find it out. Film artist also is a specified profession. His gross receipt information has been given as under. That is financial year 1920, it's 1,15,000. 2021, 180. Financial year 21-22 is 210. And he is asking for financial year 22-23. Do he needs to maintain specified books of account? The answer is no. Because in all 3 years, gross receipts should exceed 1,50,000. All 3 years. Because in this year, it is only 1,15,000. So he need not to maintain specified books of accounts. But he needs to maintain normal books of accounts. So it's this simple. You see, we just read the provision, and at the time of that diagram, you might be thinking it's difficult. And when we need to solve it, then it's so simple. 44AA, the second point we discussed, that other than specified profession and all business, if you are an individual HUF, this condition of 2,50,000 or 2,50,000 except that 25 lakh rupees receipt sale condition is applicable in any one of the last 3 years. Remember always, in a specified profession, all 3 years should be checked. But for other cases B and C, any 1 year, if condition fulfilled, then you have to maintain books of account. This is third case, 1,20,000 or 10 lakh in any of the 3 years also, same concept. This is section 44AE. I have just told you that we will discuss when to maintain books of accounts if you are running section 44AE later. Section 44BB and 44BBB at final level. So you need not to discuss about this. You need not to bother about this. Then section 44AD and AE provision. I told you we will discuss with the provision when we will discuss section 44AD and AE in detail. Next is who is required to run audit. Who is required to done tax audit under section 44A. This is also theoretical provision. I will discuss it with you in the next class because already time has been crossed. You need to do a lot of things more. And then only section 44AD, AE, etc. will be left. And section 44AD, AE, etc. is our last section because the PGBP also include the composite business provision, which you might have discussed already in the income exempt provision. That is a rule I also included, but I believe you must have read these provision in chapter number 3, that is income exempt from tax. That is rubber, coffee, etc. business. So can anyone tell me that this provision has been discussed in the chapter 3 or not? That composite business in which rubber, coffee and roasted coffee have different kind of percentage. If this has been discussed in chapter 3, then we are not going to discuss this topic in our PGBP section because this is the last section we need to discuss. So if there is anyone who can tell me that this provision has been discussed earlier or not, before that, let me take the queries. Diksha, is this section is only applicable to profession and not business? Any section is applicable for everyone. If that is applicable on that, if there is any professional in which provident fund concept, are you asking about provident fund? Diksha, please tell me. In this section is only applicable to profession and not business. About which section you are talking? Sir, if in A income is more than 1.5 lakh in 2 preceding year, but likely to exceed in current previous year, is he under obligation? No. For A case, it's only applicability when there is 3 years exceeding 1.5 lakh, then we need to maintain only in the next year in which it is exceeding. Okay, so students told me that this agriculture income provision has been discussed. Very well done. Thank you for your reply, Prati, Bhumika and Rajiv Kumar. So we will not going to discuss this provision over here. So we just need to left with section 44AD provision and section 44AB, which is regarding the tax audit provision. That is a theoretical provision. So in the next class, we will complete this part in our first hour. There will be no MCQ in the next class because we need to discuss the whole study, all questions. So if the time left, I will take the MCQ. Otherwise, when I'll take the class in next session, we will start from section 44AB and we will try to cover in the 30-minute part 44AB as well as section 44AD and AE. These only 3 sections is left from our study material or the part of notes. After that, we will take all PGBP questions and chart presentation, and we'll try to take the revision also. So please do study hard as you can. And of course, success is waiting for you. So already a lot of time, we are already over time. So goodbye, take care, have a nice day. And we'll be back on 10th of July.